Thanks for joining us for another episode of Solving the Money Problem. We're going to be joined by Aaron and Steven. The time is now. Let's dive in. What's going on, guys? It's time to talk about the infinite banking concept. We got Aaron and we got Steven with us today. So what's happening?
Hey, how's it going?
It's going good.
Hey, good morning, Chris. Good morning, Aaron. Just sitting here in my home office. This is the first place that I spoke to Aaron for the first time a couple of years ago on the phone. So kind of bringing it back to where it all started.
I think the best thing to do is let's just tell the audience a little bit about your story, Aaron, and kind of first like how you found us and about what we do with the infinite banking concept, but then specifically what you initially thought of it. Because most people, when they hear about this in the beginning, they're like, no, that's too good to be true. That's a scam. So let's start there.
The first, I guess when I first heard of you, Chris, you were on a podcast with Stephen Richards. He's here from Indianapolis. And I listened in. I was like, pretty interesting. So I text Steve. I said, tell me about Chris. He said, he's a real deal. Listen in. So I started following you and started listening to you. And then each week just started learning from you and your team. And I do remember this one thing. You had a 3-day class coming up, a weekend coming up, and you were debating about the price. And your wife says, you should do it this price. We're doing a pandemic and blah, blah, blah. And I said, damn, he listened. And sound like a good dude. So that's where my journey began. I started listening and took the 3-day class, and here I am.
So I think there was a key thing that you just said there. All you men listening to this right now, listen to your wives. Happy wife, happy life. So once you came to the 3-day, like what were the first things you were thinking about in your situation that this concept, the infinite banking process, would have helped you solve those problems?
Well, I had a 6 and 63 license of securities, and
I'm sorry to hear that.
I know. And I used to sell life insurance for a company. And when I heard whole life, I said, yeah, okay. I know what the whole life's all about. So it's kind of steering. I was taught to buy term and invest the difference. That's all I was taught forever. And then your concept that you were teaching, it was totally different. I was like, yeah, it sounds too good to be true. And then when Steve Richards said, no, he's a real deal. So that kind of made me listen more. And then you got me.
Well, you got yourself, because really we don't ever get anybody. We simply just teach you what most people should already know. But unfortunately, what we do, there's not many advisors or insurance agents out there that even understand it, let alone teach it, because the commission structure on how we build these whole life policies reduces commissions so much that most advisors don't want to know about it. Most advisors are never taught this simply because of such the commission being reduced 60 to 90%. Their brokerages and their companies they work for truly don't want them to know about this. And it's not to the fault of the advisors. And you were 663, and Steven, I know, was also an advisor. Steven, let me just ask you, you were a financial advisor. When you first heard about this, I remember the day, did you think the same things Aaron did?
Oh yeah, absolutely. I mean, not only was I a financial advisor, but I was in the alternative investment world of real estate investing and self-directed IRAs and all of that for many, many years. And I still had never heard of becoming your own banker, the infinite banking concept, and, these specially designed and engineered policies that we, now that I'm part of and ultimately helped Aaron get started with a couple of years ago. But I had never heard about it. So when I first saw you talking about it, I honestly just thought it was one of those gimmicky things. Like, hey, this is a way to kind of rope people into some kind of big upsell that they're going to hit you with later in coaching and stuff like that. And come to find out, that couldn't have been further from the truth. So even when you think you know everything, even in this world, there's still so much more to learn.
So true.
Yeah, and Aaron, one of the unique things is, we come across a lot of people, and, when I was an advisor, a big thing that we did was buy term, invest the difference. And you had mentioned that because that is a very popular concept. Mr. Ramsey and so many other people out there talk about buy term, invest the difference, which really focuses in on the cost, right? We're always talking about cost, cheap versus expensive. And, that's the big thing. And term insurance is well known that it's very inexpensive life insurance. So when you buy term and then you invest the difference in the markets, like that theory, that concept is really one of the main things taught out there. But a lot of people just take that at face value. Oh, just because it's talked about, just because that's what the advisors are saying, just because that's what, all the gurus out there are saying is the best, it must be. But they don't really understand the whole truth to why that is. And you now know, but I'll tell the audience, the biggest reason why you've heard buy term, invest the difference is the best strategy is a simple one. If you owned a life insurance company or you owned a brokerage and you had a product that you sold that only had to be paid out on less than 2% of the time. In other words, if I buy a term insurance policy, the insurance company knows for a fact, statistically, because of their actuaries, that term insurance is only going to be paid out on at less than 2% of the time. In fact, check this out. This article says exactly what I said. So if you had that product that said less than 2% of these policies will ever be paid out, where would you put your marketing dollars? Where would you put your training for your agents? Where would you put your effort and energy? Well, it would be on the most profitable product, wouldn't it? And that is term insurance. Contrary to the fact that it's the cheapest, it's actually the most expensive because so few term policies are ever paid out that for the insurance company, they can price the cost of the insurance very low because they don't have to pay out on them. So therefore, for the client buying the term policy, it's actually the most expensive product you'll ever buy, but most people don't look at that. They just look at the cost. And I was always taught, don't just focus on the cost because cost is only an issue in the absence of value. But so now they sell this term insurance policy. They put all their marketing to that term insurance policy. They train all their agents buy term and invest the difference because that's the most profitable thing that company can do. And then they also typically own the mutual fund family that they're going to start selling for that invest the difference. So they're controlling both sides of a very profitable transaction. And then you got whole life insurance, which clearly, Aaron and Stephen, you both know that we're not talking about normal whole life that you bought from your broke ass brother-in-law or from the insurance store. We're talking about a very specially designed and engineered policy that is designed to do exactly what we're going to get into here, and that is use it for the infinite banking concept, which is not a product, folks. It is a process of moving your money and taking back the banking functions. A lot of people come to us and, we always say the fastest way to building wealth is to take back the money that you're giving away, or build wealth through your own debts and expenses is another way to say it. So you heard that and you saw that on that podcast, but how did you articulate that into what you're doing?
And Aaron, for the record, I do have all the notes from our calls from a couple of years ago still. So we'll see if you remember that first phone call.
I remember the dump in and able to pull the cash right back out, and my money's still sitting in my account earning and compounding was, blew my mind. It's like, how is that possible? And it was just the numbers kind of won me over.
Perfect. And you had, if I'm not mistaken, Stephen, correct me if I'm wrong, because I don't have the notes in front of me, you had a pretty significant amount of debt, right?
Yes.
So basically all you did is you saw us on the podcast, you then got around the campfire at a 3-day event, and then you all of a sudden saw how the concept worked, and you probably saw the chiropractor example. So we give an example often in our 90-minute training video that shows you how we took a chiropractor that had $478,000 in debt and how we paid off all that debt for the chiropractor in 6.5 years without changing anything in that chiropractor's life. He didn't have to work any harder. He didn't have to work any longer. He didn't have to take on any risk, and he didn't save any more money than what he was already saving, but he changed one thing. And that's what you did, Aaron. You just changed one thing, and that's where your savings went first. So when we got into that, the other thing, you were, you got your policies issued. And then once you got your policies issued, you did a call with the mapping team, which is our proprietary team that helps, you solve whatever problem, in your case, the debt. Can you just tell the audience a little bit about what that experience was like?
With the mapping team, I'm a numbers guy. They mapped out exactly which debt to attack first, what to do with the funds, and then how to roll over each one to the next debt. And so that I just followed the steps. They were just plain and simple. Do A, you'll go to B. You get to B, you go to C, C to D, and there you are.
Love it. And Stephen, can you just jump in real quick and just kind of talk about that? Because you work with so many clients in telling them, how this works. And a lot of them think, well, that's too good to be true. There's no way paying all this debt off can be that easy. Can you just jump in and just explain a little bit about that process on how it actually does work every single time?
Absolutely. I mean, all people, all clients, everybody's different. Their financial situations. You can have somebody that has plenty of money to save and put away and is in zero debt that makes 50 grand a year. They just don't spend a lot, and have a lot of expenses. Or you could have somebody making 300 grand a year and they're into debt up to their eyeballs and living paycheck to paycheck because they're out there keeping up with the Joneses. So it doesn't matter where you're starting financially, how much debt you have. And to clarify, I'm not going to get into Aaron's personal situation too much here, but to clarify, he didn't have a lot of bad debt per se. I believe, Aaron, you had a couple car loans, 1 or 2 car loans, and most of that was real estate debt. So what we would typically consider good debt. So he had cash producing rental properties. But when you look at some of those long-term rental properties, 20, 30-year mortgages, it's like, man, what if I could pay those down quicker and then snowball that into more properties? So, we're not talking necessarily a lot of bad debt here, credit cards and things of that nature. Maybe you're in real estate, maybe you have 5, 10 rental properties and you're looking to just accelerate getting those paid off to increase cash flow so you can buy more and more properties. And that was kind of the situation Aaron was in when he first started, and that was his mindset and his goal. So it doesn't matter where you're coming from, where you can have no debt. Maybe you're just getting into this whole world and looking to accelerate what you do. But at the end of the day, the reason why we can help thousands of people and it works for 100% of them is because it's a proven, guaranteed system. Like putting your money into these policies is guaranteed. This isn't rocket science. What we do is it's very simple at the end of the day, really. And with our support and help, once you start doing it yourself, just like Aaron, you started a policy and then you started doing what? Buying more policies, right? And that's very, very common for over 90% of our clients, because once you understand it, you're going to be like, wow. And your kind of brain does that 180 turn, man, banking can be completely different. And it's proven to work over and over again. And that's exactly what worked for Aaron and works with all of our clients, because it's a proven, guaranteed method that if you just follow exactly what we tell you to do, it'll work for you too.
So true.
So can you describe your too good to be true scenario that wasn't too good to be true?
My too good to be true story is talking to Stephen I think I had a couple of small credit cards I wanted to pay off faster, and I'll be 62 in September and subject to retire at 65. I'm at a point now, I'll be 62 in September, I can retire now because I took those principles, paid off debt. Like Steve said, Stephen said it was good debt. We have rental properties, but I'm able to have a plan in place that I know where I'll be. And just being around in campfire, listening to you guys, learning, I'm putting those steps in place.
This is nothing more than a circle, okay? So the only difference with the circle is, the thing I want you to envision is over here on the left side of the circle is, instead of your bank account, it's this specially designed and engineered whole life policy. So we commonly call this the money multiplier policy. And this is where we're going to change one thing. And all we're going to do is we're going to change where your money goes first. The money I'm talking about is your savings. So maybe you have W income, maybe it's K1 income, maybe it's 1099 income. It doesn't matter what your income is. Some of that money that you make, you save. Aaron was doing the same thing. Every one of our clients saved money. And that savings typically either went into a 401k or some type of a retirement account. Maybe you just use a savings account, which would be a darn shame if that's what you're doing. But that's okay, because you just don't know what you don't know yet. So you just change where that savings goes. So Aaron, when you started your first policy, how much money were you putting into it each year?
$7,200.
$7,200. So that was the amount each year that you were saving somewhere else. And then not only that, you had some extra money just sitting around being lazy in a bank account, right? And then you did what's called a dump in. So you just moved the money from your left hand over to your right hand and you dumped in some money as well.
Yes, I did.
Okay, perfect. Do you remember how much that dump in was?
About $12,000.
Okay. So we dumped in $12,000 and then we put $7,200 in a year, correct, Aaron?
Correct.
All right, so folks, all he did is he just took the same thing he was already doing out there in a different instrument, a savings account or something else, that your situation may be different than Aaron's, and he put it in here. Now, immediately when he put the money in, we, the mapping team for that, designed a plan to pay off all of his debts. And he had a whole bunch of debts, starting with credit cards. Now, how many of you watching this right now have credit card debts? I bet you 90+% of you have some credit card debt. And credit cards, Aaron, how much were you paying in interest roughly on your credit cards?
10%.
10%, which would be very low. The average person in credit cards is paying over 20%. So I'm just going to say 10 to 20%. But whether it's 10% or 20%, that's a lot of money. And then there's always going to be a monthly payment you have to make for that credit card debt. So Aaron, do you remember how much your credit card debt was?
I believe total was probably $12,000.
$12,000. All right, so we had $12,000 in credit card debt, paying 10% interest, and this might be a bit hazy because I know it was a while ago, but how much was your monthly payment for those credit cards, that $12,000? Do you remember what you paid?
I was paying the minimums, so 120.
Okay, so about 120 bucks. So now we've got all the money on the credit cards, and all we're going to do is we're just going to talk about his first debt that we were going to pay off, which the first debt we would always pay off for any client, including Aaron, is going to be the lowest balance, which was his credit card debt. 10% interest, $120 a month he was giving away to the credit card companies, and that was the minimum, which means that's just the interest on the debt. So that money's he's never going to pay those credit cards off doing that. So now follow with me. Remember the circle that I drew. All we did is we changed one thing, where his money went first. So he dumped in $12,000, and then he also put $7,200 in each year thereafter. Immediately after depositing the $12,000 and then the $7,200, whether he did it monthly or annually, doesn't matter, we immediately took the money out of his specially designed and engineered whole life. So let's just pick on $12,000 because that's the amount we need for the first goal, which is to pay off the credit cards. So what we're going to do is we're going to take $12,000 out of the policy and we're going to take it out as a loan. So now earlier you heard Aaron talk about when he puts the money in this policy and when he takes the money out, this loan, that money didn't actually leave his policy. So let's just say he put $12,000 in immediately and then he dumped and he put $7,200 in thereafter. All of that money, the $12,000 plus the $7,200 is still in his policy. So whose $12,000 did he take out and move into his segregated bank account? It was the insurance company's money. The insurance company gave him a loan against his death benefit because all life insurance, I don't care if it's term, universal life, or specifically these specially designed whole lives that we're talking about, the insurance company promises to pay a death benefit someday when we die. So therefore, in the way we design these, Aaron has the ability to access his death benefit and leverage it in the form of taking a loan. The insurance company gave him $12,000, which was $12,000 of his death benefit that they lent him while he's living. And they charged him an interest rate of roughly 5%, if I'm not mistaken, Aaron, right? About 5%?
Correct.
So his interest rate is 5%. Now, some of you are thinking, why the heck would Aaron put $12,000 and $7,200 in this whole life policy when they're going to charge him 5% to use his money? Couldn't he have just kept his money in his bank account and not had to pay interest on it? This is where most people fall short on the understanding, and this is where a lot of people start questioning this, but let me just show you the math. The $12,000 plus the $7,200 he put in, let's just assume that he was with a carrier, which I believe, one of your policies is, that was paying him 6%. There's a guaranteed interest rate that they pay plus a dividend, and let's just assume that it's 6% interest. If it cost him 5% to use his money or borrow his death benefit, but he's earning 6% on all of it because his money never even left his account, he's making a spread, right? In that, you guys can all do the math. 6 minus 5 is 1%. So he's making a 1% spread. How many of you have a bank account that allows you to take all your money out and make a spread of 1%? The answer is probably none of you. Banks don't work that way. Wall Street doesn't work that way. These are the only vehicles, these specially designed and engineered whole lives, that allow you to do this type of a thing on a guaranteed basis. And the best part is, Aaron, when you took this $12,000 out, that loan against your death benefit, the most important part is what we did next. See, when he took the loan, the money within 36 hours was in his bank account. And we always have our clients open up a segregated bank account. In other words, not to make that complicated, go to your bank and open a second bank account. That's all this is. It's just a new bank account. And instead of having all the loan money, the 12 grand, go into your existing checking account where it seems like a bottomless pit, every time you put money in, it's poof, gone. The segregated account is just used for the infinite banking concept. So we got 12 grand. Now what we're going to do is we're then going to use the 12 grand to pay off his debt. So now he had $12,000 in debt. We paid that off. No more debt to the credit cards. But most people would just stop there. They'd pat themselves on the back. They'd be like, oh, great, I saved 12 grand and I paid off 12 grand in credit card debt. I'm done. Aaron had learned from us that that's not where it stops. That's only the top part of the circle. We took money out, we're earning uninterrupted compound interest on every dollar, and we paid off the credit card. The most important part of this equation is the bottom part of the circle. And the bottom part of the circle is where you treat your money the same way you treat the bank's money or the credit card's money. Every month, Aaron was making a $120 payment to these credit card companies, which was 10% interest. So now that he doesn't owe $120 to the credit card companies, what he's going to do is he's going to change the name on the check. That's it. He's going to take $120 a month, and instead of paying it to Wells Fargo, Amazon, Bancorp, any of the credit card companies he was paying, he's going to write one name on that check, Aaron. And the money is then going to go from his bank account back to his private bank, which is a specially designed whole life. $120 a month is the same amount he was given the credit card. Now he's paying his bank back $120, which means he also is recapturing 10% interest by doing this. So he's taken 10% he used to give away, and he's now earning that himself. Plus he's earning the spread on the money from what his policy earns him to what it cost him to borrow his death benefit. And the best part about this, folks, is every single year, Aaron's spread and any of our clients' spread goes up because of something that everybody should know, but so few of the people that we speak to actually understand, called compound interest. So Aaron, you understand compound interest. So everything I just drew on that board right there, is that exactly what you did with yours?
Exactly.
What did it eventually do? Did it hurt you financially? Did it help you financially? And then how did you transition from paying off debt to where you're at today?
Well, it didn't hurt me at all. It just made things a lot simpler. I've learned how to, since I have an LLC, kind of just made the circle go to the LLC, pay myself, and just complete the circle a different way. But I learned that just being around you guys, listening on the campfire, being around the campfire and learning different things. So definitely has helped me. Now, during this whole process and this journey that you've been on from, being an advisor, Series 6 and 63, to then kind of transitioning over into this unknown world, that you saw on a podcast, and eventually then just got around the campfire and started learning more and more and more. After the debt was paid off, how did you start using your policies after that? Started loading them up. Actually got another policy for my grandson. Using them more as a banking policy. Okay. Now, do you use it for any real estate transactions? Because I know you're a real estate investor. I'm building the one up to purchase another property. Awesome. So, Stephen, I want to have you jump in a little bit and just kind of talk a little bit about real estate. Because, all of us on this right now, we're all real estate investors, and a bunch of the people watching, I'm sure they're real estate investors as well. What are some of the ways that this can be used for real estate, whether it's directly buying like what Aaron's going to do, or actually just being the bank and just
not owning any real estate, because a lot of people don't want to actually own the property, but they want the benefits of what the property can do. Can you talk about that for a second?
Yeah, absolutely. I mean, if you're an active real estate investor, you typically make good profits on a deal. You're taking that money, you're sticking it into the bank. It's sitting there and waiting for the next deal. You pull it out in the next deal. When you pull it out of the bank, it's no longer earning. Not that it's earning. This is 2022 right now for the record. There's no interest in savings accounts or anywhere right now. So beside the point, so it's kind of transactional, but if we can flow that money through the policy, now we're taking advantage of uninterrupted compounding interest for the rest of our lives and simultaneously still using that money for the exact same active real estate deals, whether that's gap funding, whether that's a down payment on a long-term deal, whether that's funding the rehab costs or the entire purchase. I mean, there's unlimited ways to use this, but one of our clients' most favorite strategies right now for taking back their control of their money is more of a passive investment, which is what's called private money lending. So if you ever need to borrow money and the bank no longer wants to lend you anymore, you just need the speed of getting money quicker, private money lending is a great solution for that. So one of our clients' favorite strategies is to pull the money from the policy and invest that in a real estate deal through a private money loan. And the way that a private money loan works is exactly like the banks do. So a bank lending you money on a 30-year mortgage, you're in first lien position. They underwrite the deal. Well, as a private money lender, we do all the exact same stuff. We, charge interest. We receive monthly interest payments. We set the terms. We underwrite the deal. We're in the first lien position, protecting our money. So it's a great strategy for using the policy because we're taking the money out of the policy. And let's say we're paying, let's say 4% to be able to do that to the insurance company. We're lending it at, let's say 10%, and we're making what's called a spread or an arbitrage there. And simultaneously, our money's in the policy, compounding and growing at the exact same time, tax-free. So we're allowing our money and our wealth to grow in two different places at the same time, completely safe and completely secure through real estate and through the policy. So it's a great solution. And something that we've created is the Private Money Club to be able to help facilitate some of those transactions happening.
That's awesome. Thank you. Now, Aaron, one other thing too I wanted to go into, and I don't know if you want to talk about this, there was a little blip in your overall plan. Not so much with the infinite banking concept or the specially designed and engineered whole life, but if I'm not mistaken, you did some things that were kind of against what we teach and what we always talk about. Do you mind talking about that just for a second? Because I think there's, in every failure, there's a lesson that everybody should learn.
Yes, I know. Listening to you guys and learning about the laws of wealth, I went against one of the laws of wealth, trying to beat it. And you know what the end result's going to be? I lost. I lost 40 grand in maybe 10 hours. Went to bed at night, woke up, looked at my phone and was like, whoa. Yeah. So chasing higher returns, that's how I lost that money.
So folks, what Aaron's talking about are the 6 laws of wealth. And he's talking about law number 4, which says, if you seek unrealistic returns, your money will flee you. Now, Aaron's not the only one that has been guilty of going against this law. I've also done it. I know Steven's done it. We all want to chase those big returns. We see this guru on Instagram or TikTok that says, oh my God, there's these huge returns. Just do this, 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 and this. It's so simple. And then you're going to earn 40, 50, 60% return. I'm not saying all of them are bad, but a lot of times when you're promised or kind of led into these unrealistic high returns, which are very appealing. I mean, Aaron and Steven, I'm sure you both can agree, like that's just an appealing thing. When you hear that, you're just like, wow. But if you do that, just know, like what Aaron said, your chance of losing your money are drastically increased because you are violating the 4th law of wealth. So don't seek unrealistic returns. And if you do, just know there's a high probability that your money will flee you.
Overnight.
Overnight. Well, I don't know if everybody loses it overnight, but a couple of the examples certainly would be overnight losses. Stephen, real quick, do you have any stories of people that have violated the fourth law of wealth? Because it just seems to be the times, right? We're at the top of the market. Everything seems to be making a ton of money. And there's just a lot of people going out there chasing these unrealistic returns. I was on the phone with a gentleman who runs a podcast, and he's like, well, you guys are always talking about these 6% returns with these policies, and you're talking about private lending deals that are 10 to 12%. Boring. He's like, that just doesn't get, the younger millennials interested. They just don't really see that as a good return today. You got to be talking about 30, 40, 100% return. And I kind of laughed at him and I said, oh, you mean seek those unrealistic returns that most people will never actually realize those returns? And he says, yeah, but that's what people want. It's funny that most people want something that they will never actually realize, but they want it because that inherent gambling desire that we all have within us to seek those unrealistic returns. Stephen, what do you have to say on that?
It's a great point. And we've seen a lot of that with crypto. I mean, especially with the shit coins like the Doge and the what's the other dog and all that stuff, right? So you're constantly hearing this stuff pumped online. You'll hear, you go on Facebook and your feed is full of people. Hey, buy this. I'm buying this. Why aren't you buying it yet? Let's all get into it. And that's when it's doing what? When it's going up and up and up and up, right? Just constant 10% daily increases. And then all of a sudden it never fails. It always at some point does what? Boom, drops like a rock. And then all of a sudden you log into Facebook and it's silent. Where is everybody? Now we're talking about politics, or we're talking about whatever the next thing happened at the Oscars or the Grammys or whatever the news of the day is. And now I don't hear anything about crypto. So that's just a great example right there. That's something we've all seen happen in the last year or two, and we'll probably continue to see that kind of thing. But one of our favorite things to tell people when they start saying, "Hey, I'm making these incredible gains. Like you got to get in with this." Our answer is awesome. Congratulations. Keep doing what you're doing. My only challenge to you now is keep it. Right. And you said it, Chris, yourself, unrealized gains. What that means is you can have your crypto going like crazy, but unless you sell it, you cash out and you actually now have that money where it's now in your control again. It's not actually profit. You're not actually keeping or gaining anything. So if you can make that kind of returns and you can, at the end of the day, actually keep it and get out, then congratulations, good for you. Because I have a feeling the next time you try to attempt that, you might give all those profits back at that point. And, I always say with things like that, if I'm going to gamble my money, which I truly believe those kinds of investments are gambling. I'm going to go to Vegas and get free drinks and stay up till 6 a.m. with a bunch of my buddies and have a good time in the process. I'm going to lose all my money. I'm not just going to click on Coinbase and lose it all overnight because something happened, right? So have some fun if you're going to lose your money. But the bottom line is if you seek those unrealistic returns, at the end of the day, odds are your money's going to flee you and you're going to lose it all. If not, try and keep it and good luck with it.
Absolutely. It always brings me back, folks, to the story of Kennedy Sr. back during the Great Depression, or right before the Great Depression. He was, back then they got their shoes shined a lot. There were shoe shine boys all over the place. And he was getting his shoes shined, and the shoe shine boy starts giving him stock tips. You should look at this stock. You should look at that stock. Because back then, in the roaring 20s and right before the Great Depression hit, everybody was making money everywhere by buying stocks and using margin, which is basically borrowing money against the stock's appreciated values. So he's listening to this shoe shine boy. And now, just so you all know, Kennedy Sr. was a very savvy investor. He had been investing most of his life. So he's listening to the shoe shine boy give him stock tips. So when his shoes are done and he's walking back to his office, he starts thinking to himself, if the shoe shine boy knows more than I do about stocks, and I've been doing this as a profession most of my life, maybe it's time to get out of the market. And you all can look up the story of the shoe shine boy and Kennedy Sr. He went back and he started to sell all of his stocks. And then he took a short position on stocks, betting against the stock market. And then we all know what happened in 1929, the Great Depression set in. Well, the story is, the shoe shine boy probably lost all of his money, but Kennedy, who went against the grain and did what everybody else was unwilling to do and took that as a sign that that was a good time to not seek unrealistic returns, he ended up making, to the tune of probably today, what would be billions of dollars by taking his gains off the table and by then shorting the market. Now, I'm not suggesting you short the market. I'm simply telling you that sometimes you got to know when to hold them and you got to know when to fold them. And not only that, somebody we all know and Aaron has heard about probably so many times. Aaron, you're probably sick of me talking about this man, but Warren Buffett. Warren Buffett says it the best. There are 3 basic rules to making money with any investing. And it is number 1, buy low. Number 2, which I think is the hardest one for people to do, is sell high. So if you buy low and you sell high, the 3rd rule is don't lose money. But if you just do 1 and 2, you can't lose money because you bought low and you sold high, and that is the name of the game. I just think too many people allow greed and FOMO to lure them into the gurus, the fraudsters, and also the unrealistic returns. And because of that, their money flees them, and then they have interesting stories and lessons that they get to tell. But in those lessons, we all have to realize that it's the wisdom that we need. And Aaron, I'll come back to you. That decision you made that ended up poorly for you, did you learn anything from that?
Oh, yes. The main thing I learned was the laws of wealth are there for a reason. Follow them and adhere to them. I never, I knew the war was going on, but I never expected it to happen just like that. And boom. There's no short steps. There's no shortcuts,
Well, there's no short steps or shortcuts. As we always say, and we just talked about it this weekend when you were there with us, inch by inch is a cinch, yard by yard is hard. We just got to focus on the inch by inch, the easy wins, the slow wins, being consistent and persistent, and that's exactly what you're doing now. So as we kind of wrap up this solving the money problem, can you just real quickly in your words just explain to anybody that's seeing this, like what you think is the best advice you could give them when they're looking at something that seems too good to be true? Like, what would you give them for advice?
I would say trust the process. Look at the numbers, trust the process. This is real.
Fantastic. Stephen, what is the advice you give to people?
You know what? Do what you understand, get an education. Mentors and coaches to me have been very important in my life. And, having somebody that you can trust, that you can follow. And like we always say, come around the campfire. I think Aaron mentioned it when we first started this conversation a little while ago. He really, when he first met us and had those first phone calls, he just started getting around the campfire. And, I think we do a very good job of, making that accessible for people. We put on 4 or 5 webinars every single week, whether it's Zoom or lives on Facebook and YouTube. We put out new content every single day on the YouTube channel, youtube.com/the Chris Naugle. Go on there, subscribe, hit the little bell. It'll alert you whenever new content's up, whenever we go live. And the Wealth Webinar Wednesdays, the Money Club Mondays, the Ask Me Anythings, the WTFs, the business trainings. This is stuff that every one of you, there's no cost. It's free. It's completely free. When I first met Chris, and especially right after COVID hit, and we had to bring everything from our live events to online to Zooms and things like that. We had a conversation, and basically it was, let's give all our best stuff away for free. And at first it was like, that was kind of weird sounding. It's like, no, let's charge. This stuff's too valuable to give it away for free. But at the end of the day, it's sharing is caring, and it's making information available. And I truly believe if you understand this stuff, you'll be with us for life. And whatever we do into the future, you'll be there with us. And that's what it's all about. If we create these win-win situations, if you can win, we know that we'll eventually win, even if it's a loss leader to start with. And that's what a lot of the things that we do. So take advantage of that, because there's not a lot of people out there that are willing to do that are willing to give you their best stuff for free. So I think it's a testament to what you do, Chris, what we've done with Money School and the Money Multiplier. And Aaron, it's amazing to see your growth and what you've been able to accomplish over the past couple of years, just by hopping on those webinars and starting slowly and just building from there. So congratulations to you. And it's an honor to know you, sir.
Thank you.
Well, Aaron, thank you so very much for your time, your story, kind of bearing some of the hard facts that you've had to go through by not abiding by the laws of wealth. And I appreciate you coming on to solving the money problem today.
That's one of the reasons why I wanted to share about not abiding by the laws of wealth and show someone a real example.
Fantastic. Well, we appreciate you doing that. We know talking about hard things and losses and, you know, the mistakes we make is sometimes tough. So I commend you for actually coming out and sharing that with the audience.
Appreciate you. Appreciate your whole team.
So folks, you heard it first. This is Solving the Money Problem, and I'm going to leave you with a quote that has changed my life from a man named Will Rogers. Will Rogers said, "The biggest problem in America is not what people don't know." He said, "The biggest problem in America is what people think they know that just ain't so." Be careful who you take your advice from. Be careful who you follow and what you learn, because it's not what you don't know. It's what you think you know that's going to get you in trouble. We'll see each of you on the next episode of Solving the Money Problem. Until then, thank you. So thanks for joining us for another episode of Solving the Money Problem, where we got to hear about how Aaron took back control of his money, how he recaptured all the money he was giving away and started to build wealth with that, and also what he plans to do in the future by using that concept to buy some real estate. You also heard about how he actually failed by not following the laws of wealth. Make sure you follow those. They'll serve you right. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.